Good morning, good afternoon, or good evening, depending on where you are on the planet. And welcome to the TGI Friday. Thank God it's Friday, the 14th of April, Bull versus Bear. The Bull versus Bear webinar with Steve Miley here on the Call for Trading. Welcome, everyone. I'm back at home, back in the UK, so all good. Safe travels on my way home. Thank you for the good wishes from everyone that sent them through. Appreciate that. So yeah, all good here at my end. Just a heads up, actually, I'm back at home. I live pretty much next door to a church in a small village, and they've been practicing their bell ringing for the last 20-30 minutes. They did stop just before we started the webinar, but they may start up again. So if you hear bells in the background, that's what it is. So let's push ahead. I'm going to go through our usual run through in here today. There's not a huge amount to say, but enough for us to fill the webinar. And we're going to take a look at the calendar, what we've had, what we've got coming up. Take a look at the fundamental macroeconomic events and data points, or the fundamentals that are impacting markets right here, right now. And we'll take a look at the charts to see where the opportunities might lie with the charts in the major markets that you guys trade with us at Trade Day. Primarily, you guys are trading the S&P and the NASDAQ. So let's take a look at the calendar first of all. Light on the data front this morning out of Europe and Asia. Nothing in here really to report in here. CPI data in here out of France, slightly lower, so obviously better than expected. On this CPI data, but the HICP data in here is slightly higher than expected. So mixed from France, no real impact from the markets you guys are looking at. Good morning, Greg. And in here we've got coming up today, what we're focusing on. Well, retail sales in just under the hour now, in just under 1 hour, core retail sales. Usually does move markets, so certainly watching out for that. 8:45, then we get Waller is speaking. Then at 9:15, industrial production. 10 o'clock, business inventories. And then probably the more important than that is the Michigan consumer data in here, Michigan consumer sentiment data. So watching out for that a little bit later in the day. So those are the focal points going into today. Nothing massive, but important enough, okay, so for us to be keeping our focus on, and certainly can be moving markets on the short-term basis. Probably bigger picture, more important, but we've had most of it out in here already. We have, let me just refresh the page to see if there's anything whether a City Group had dropped in. No, but we've had obviously earnings season kicks off today. We've already had most of what we got coming out. Citigroup still to report. Most of these you can see are in the red. In the green. Most of these are in the green in here. JP Morgan, Wells Fargo, BlackRock to the most part, even where it's a miss in here, but it's a tiny miss in revenue. And United Health outside of the financials also in the green. So beating expectations across the board. So slight positive coming through from the earnings season so far. Still got Citigroup to come through in here. And First Republic Bank, which is obviously going to be a fairly big focus on that. Whether what you interpret from that, I don't know though. But I'm not a bank specialist, but nevertheless, First Republic Bank coming up later today. Citigroup and First Republic Bank, but most of those in here obviously better than expected. So a positive spin. Five things to start your day shows how little there is going on in some ways. In that, I mean, most of this in here is all political stuff. So, this arrest of this guy who's done the leak, embarrassing for Biden, but not market impacting. US is pressing the need of allies to coordinate against economic coercion. Again, nothing is going to impact us. China mega banks in here, nothing is going to impact us. And then what's going on in markets? Well, markets steady. Well, great, telling us nothing. And then what we've got coming up, and I've already run through that with you guys already, the data. So there's nothing really in there. I will point out, I think the most important thing in here, and maybe actually, I'm going to park that for a little bit. Let's park that to when we get to the charts. I'll come back to that. So Wells Fargo data, profits rise 32%. I haven't got articles in here on all the different reports that we've had from the earnings so far, but generally better, higher as rates bolster interest income. Yeah, so higher rates, we're in a higher rate scenario is good for banks. S&P and Dow initially were lower than we are now. Have rebounded on those earnings. Parry losses after resilient bank earnings. So we were actually down this morning, but managing to pop back higher. JP Morgan profits surged 52%, and BlackRock profits beat robust inflows, so inflows into BlackRock as well. So all of that is very positive coming into today. And this is behind Nasdaq futures. Well, they actually are. Nasdaq is still behind, and it's saying that JP Morgan, Chase, Wells Fargo among the first to report. But this was obviously written before they'd reported in here. I know kicked off a busy earnings season. JP Morgan jumped about 8% in the pre-market, and Wells Fargo down 1%, even though the numbers were good. So yeah, generally good in here. And the only thing we had actually I didn't mention out of Asia, PBOC, People's Bank of China, pledged stronger support to economy amid uncertain recovery. So that's a positive, a more dovish tone, a more expansionary tone from the PBOC, certainly a positive. And then I just want to exclusive in here, Fed can hit the mark and hold with one more rate hike. So Bostic in here, Fed member in here, looking for one more, an interview here, I think, with him, one more quarter point hike, and then probably going on hold. Okay. So there we go. One thing I just want to point out, just a bit of sentimental from my side, they're getting rid of the euro-dollar contract from today, apparently. It ends. So here's the euro-dollar pits from back in the day on the Chicago Mercantile Exchange. These are being superseded, the CME euro-dollar contracts in here by the secured overnight financing rate. So effectively, it's the same thing. It's still the interest rate market, but the product actually is changed. So it's no longer euro-dollars as it used to be. And so, yeah, just a little bit of sentimental stuff, more for me than probably for most of you guys out there. But the end of the euro-dollar contract. Where are we in European bourses? Well, we're slightly higher in here. We also had a strong close in the US. Remember, US actual cash markets are closed before the US closes out. So we're playing a little bit of catch up in here because we had that strong late close on for the US stock indices. And US stock indices, a good day yesterday, up at the highs. We'll look at the charts shortly. Dow Jones and Nasdaq and S&P all adding over 1%, and hardly a dip really. Dow and S&P pretty much unchanged this morning. The Nasdaq is hit slightly, and I'm just going to talk about that shortly when we talk about the yield chart and the interest rate chart. CME 2 in here, we covered it in depth in here the last few days. But really not much change. This is continuing to push higher. So more and more chance, more and more acceptance. We're getting a rate hike at the next meeting. This is for no rate hike. So, and this has been sitting around between 60 to 65% pretty much. Now up to nearly 75% chance of that. So pretty much nailed on for a 25 up at the next meeting. And then we're looking for it to be on hold in June. And then by July, though, the market's starting to price in a cut. Although the Fed tell us no cut, and then still cut by September, November, potentially getting towards another cut, and then December looking for probably 2 cuts by the end of the year. The Fed obviously tell us no more rate cuts, no rate cuts this year. One hike, no cuts. So it's going to be interesting to see how that plays out. They did, obviously highlight we've had inflation dipping lower, so that would open the door to them to be more dovish. We've also saw the Fed in their own minutes in here highlighting risk of inflation. Risk of recession. Okay, and that's obviously going to potentially see them pivot. And then PPI data yesterday was positive in that we saw much lower than consensus. So that PPI data as well, adding fuel to the fire of maybe rate cuts coming later this year. Let's go and look at that yield chart in here. So this other thing, this is what's holding the Nasdaq back. So despite the fact that since this week we've had, and that was the Wednesday, and that red bar there. So we did get initial move to lower yields, and then we've had a pop back to higher yields. So the move to lower yields, obviously, from the US, 10-year note this is. The move to lower yields was on the CPI data, and then we did stay down there and push down there again on the Fed minutes, but ended up and then up yesterday in yield, and then nudging higher again in here in yield. So nudging at the door around 3.45% in here, 3.46%, excuse me. I think the risk is that we can push higher in yield here, and that's what's holding the Nasdaq back. That's why you're seeing those numbers on the Nasdaq this morning as lower compared to the S&P. And here it is on the price chart. This is a 10-year note on the futures, the June future in here, and you can see there's the spike higher through the CPI data. Then the market comes back, it goes back up again on the Fed, but then ends up back lower in here. So, and then pushing lower in here this morning. So real risk in here, you've got a load of support. So I think you need to keep an eye on this if you're trading the NASDAQ. This is where all the underperformance from the NASDAQ, whether you have this you've got this kind of topping line coming through here. Oh, why did that not work? So you've got this line coming across here. Seems to work quite well. In here, Oh, why is that not working? It's not working for me. Frozen. Oh, there we go. Okay, so this line in here, so down through like 115.09. You got this low in here is at 115. 9.5, and then the actual low in here, more recent low, is 06.5. But through 09 really is this line. I think that little sees treasury is more vulnerable, and if we see 10 years selling off in here, we could easily see a significant. It doesn't mean the Nasdaq goes down, but it just means it probably underperforms the S&P. Okay, you could still see this going down and the Nasdaq going up. We certainly saw that yesterday. We saw a sell-off yesterday in here on bonds, and we saw stocks going higher. Let's take a look at, while actually I'm on this tab, I'll do the commodity markets, and then we'll switch to the, so here we go. Oil is staying firm. We had that breakout earlier this week, having been in that range. Bullish breakout extension, dip yesterday, but then look, dip and a rebound in here this morning. So we go to the 30-minute chart in here on oil. So there's the breakout. Okay, we've given back some of that, and then dip and a rebound this morning. I think oil clears back above. Where are we? 82.57 looks more bullish in here. Okay, and we can easily see it back up to the highs and above maybe on oil. Let's take a look at gold. Staying firm, pushing to new multi-month, multi-year highs in here. A little bit of a dip and a rebound. Again, breaking above to a new high yesterday. Dip and a little bit of a rebound in here this morning. Probably waiting for the next swing up. You can either have the little counter trend line that comes down through here. Either have this on, or I'd be looking to simply go above the recent little swing peak there from the last, the last couple of hours. So above like 20, 56, 57, that looks more bullish, and then up to and through the highs. So staying bullish there on gold. If gold takes out support, I'd say down here, like 20, 39, 38, looks a little bit more vulnerable. Okay. Right, let's turn our attention to the stock indices. Start off with the S&P, which did lead us higher yesterday. So basically reversing the sell-off that we saw on Wednesday, reversing this potential like shooting star pattern. We did hold on to a bullish tone. Look at that 13-period exponential moving average again yesterday. Can't keep stressing that enough. If you're watching these webinars, you should be watching that every day, right? Have that on your chart, 13-period exponential moving average on the daily chart. It does pierce through it, and it does go through it, okay? But if you're trading maybe like if you're trading not necessarily very, very short term, but if you're trading maybe holding positions for an hour or two, you want to be, thinking about buying every time it comes to this 13 exponential moving average, and then looking for the rebound from that. So we made a new closing high yesterday. Didn't make an intraday high. The high from a couple of days ago, from after the CPI data, was up at 77 and 75. Yesterday got to 77, but it was a closing high since back over here since the middle of February. Actually, since my birthday, 16th of February. So closing high since the 16th of February. This looks still bullish in here. This is like a high level consolidation overnight. Seeing the market just sitting there overnight. We had this kind of little flag pattern back in here, like flag pattern on the way back, and then pushing back higher. We're already through this kind of little counter trend line you could draw across the top. So for me, all the risk is still just higher in here. I think it's really got to get below the overnight low for it to start to look more negative, really. Then you could retrace like maybe half of yesterday's move if we get below the overnight low, but overnight low being in here down at 61.75. But I could easily see it taking out that 77, 75 high there, and then going back to the daily chart. Where can this? Oh, no. It jumps out at me like this sometimes. All right, I'm going to have to open a new tab. 1 second, guys. I'm not sure why that happens. It just jumps like that. Anyone can help me out with that one, I'd appreciate it. Because every time, it's not the zoom, it doesn't zoom in. Let me go back to that chart. Okay. So actually I want it on the daily chart. So where can we go up to if it breaks the highs? Well, up into this space here. So somewhere between 4,200. 42 to 42.05 is an easy target, I think, today. So that could be the zone we're looking at. So let's look at that NASDAQ underperformance. There you are, look, not making a new high in here. We reversed all of all of Wednesday's losses. So it was robust. Remember, we did close below the 13-period exponential moving average back on Wednesday. Reversed all that yesterday. Didn't quite get back up to yesterday's highs. More negative in here this morning. And again, why is it more negative? It's because of this, guys. It's exactly because of this, right? And obviously the broader market's being helped out. So it's because of this. It's because of this, the 10 years here. It's because of the 10 years nudging lower in here. It's because of this. It's because the yields look pushing higher now as we speak, right? This is holding the Nasdaq back, right? So if you're trading the Nasdaq, you've got to be aware of it. You might be seeing the S&P pushing higher and the Nasdaq, more beleaguered, and more, and not being able to track the strength that you might see in the S&P today. So just watching out for that, and you can see it right here on the daily chart on the S&P. That high level consolidation, holding on to the gains, back down lower and then popping back in here overnight. And you look at the Nasdaq still down in here overnight. And here we go. If I zoom in now on the Nasdaq, look, there's like the same kind of flag pattern, and then boom down and nothing back. The S&P is going to benefit from those financial stocks rebounding. The Nasdaq's not, right? So you have to take this into consideration today. Watching that treasury market, okay? If we continue to nudge to lower prices, higher yields in the treasuries, the Nasdaq's going to underperform, and it might be a matter of if the stocks broadly sell off, you want to be selling the Nasdaq, right? If we see a broader rally, you probably want to be in the S&P. And I know some of you do jump between both contracts, and I think that's a good tactic. When you see an underperformance and outperformance by the two averages. Okay, in this case, if you are only trading the Nasdaq and you want to play it from the long side, you have to be careful, right? You're going to get underperformance. Don't just buy it because the S&P is going up. It's going to underperform likely, and keep an eye on those treasuries as well. I can't be as bullish in here, particularly if it breaks down below these little lows here. 13,102.5 down through there, it looks a little bit vulnerable to a deeper correction. So watching out for the Nasdaq, okay, watching out for the treasuries, and being a little bit cautious. On the short side, I think you're fine. On the long side, you've got to be careful, I think. All right, guys, I'm going to wrap it up there. Any questions? Any questions? Don't see anyone typing. No. Okay. All right. I'm going to wrap it up there, guys. Have a great trading day. Take care. Stay safe. Have a great weekend too. And I'll be back with you with another Bull versus Bear webinar on Monday. Bye.